Well, good afternoon. Happy Friday, March 25th. Mark Milam here, your mortgage professional with Highland Mortgage, coming to you with this week's interest rate summary and market update. Not a great week for mortgage interest rates. Unfortunately, we've seen rates deteriorate or worsen by about 1/4 of a point on average since the beginning of the week. This comes off of interest rates deteriorating by 1/4 of a point the week before, meaning over the past 2 business weeks, we've seen interest rates decline again on average by about 1/2 percentage point in rate. That's a huge move in a very, very short amount of time. Very difficult for home purchasers who are out there looking for the right home. 2 weeks is a very short window to see that kind of market volatility, and it's really exacerbated by what we've already lost in 2022 in terms of pricing power. As home prices continue to go up due to limited inventory, interest rates now going up, really impacting affordability across the United States. As a matter of fact, we got a report today showing that pending home sales, which were estimated to increase by about a percentage point, actually declined by a little over 4%, a pretty big miss in terms of what was anticipated in terms of pending home sales. A lot of factors around this, not the least of which is not enough inventory out there, but also just certain people that are just deciding, hey, we're going to stay on the sidelines. We're not going to buy yet because it's just too expensive. Between the price of homes and the price of money, we're seeing affordability get squeezed. That's exactly where we are, and it's not going to get a whole lot better, unfortunately. Here's what's a little curious. So back Wednesday a week ago, so not this past Wednesday, the 23rd, but a week prior, we had the federal funds rate increased by 1/4 of a percentage point. Everyone anticipated that was coming. Of course, all eyes were on the Fed policy statement, which came out at 2 p.m. Eastern time, and that was a week ago Wednesday. And the Fed took a very balanced, measured tone. Didn't really roil the markets with their policy statement. It wasn't a great day for mortgage-backed securities, but it wasn't a terrible day either. Fast forward 72 business hours after that policy statement, we have the Fed with a microphone, the Fed chairman with a microphone in front of him, taking a much more hawkish stance in terms of interest rates and the hikes that are coming for the Fed funds rate, which is very, very curious. You have a measured, prepared, anticipated policy statement on a Wednesday, and then the following Monday, you have a very different tone taken by the exact same chairman of the Federal Reserve. Caused a lot of volatility in the market and is a little difficult to explain. I'll show you exactly what I'm talking about. I'll flip the screen around here and we'll take a look at mortgage-backed securities. So this is the financial instrument upon which mortgage interest rates are based. Red days or bad days, plenty of those on the board. Not much in the way of green days. And we can see if we go back to Wednesday, this is Wednesday, March the 16th, when the Fed made their policy statement, right? And we can see where we were there. Thursday and Friday, look at how the market reacted to the Fed's policy statement. We actually saw improvement in mortgage interest rates from Thursday to Friday. And then here comes Monday, March 21st, where the Fed has a press conference and makes some very hawkish statements in terms of 1/2 point Fed funds rate increases that are on the horizon. Going to take a very tough stance on inflation. He thinks the market can handle it. And boy, we got hammered on Monday, hammered again on Tuesday, recovered a little bit on Wednesday, and then Thursday, and then now today, Friday. This is all in reaction to the Fed taking such an incredibly hawkish stance. And now Citigroup has come out today and they are pricing in 1/2 point Fed fund rate increases for May, June, and July. So the next 3 Fed meetings, which are scheduled in consecutive months, May, June, and July, Citigroup is now pricing in 1/2 point Fed fund rate increases at each one of those meetings, meaning by the middle of summer, we're going to have a Fed funds rate that is 1.5 points higher than what we have right now. That's a lot of volatility for the market to absorb, and mortgage interest rates are behaving accordingly. The unfortunate reality of this is that there's not a lot on the horizon to reverse this trend. We still have supply chain issues. There's been another COVID outbreak in Asia and China. That's going to disrupt supply chain. We know about the war in the Ukraine. That is obviously disrupting the easy flow of oil. It's going to cause oil prices to go up. And until we get some better readings on inflation in this country, interest rates are going to continue to climb. That is just the unfortunate reality of where we are. And of course, affordability is going to get squeezed. The last time we saw indicators like this was back in the late 70s, early 80s, and that was something called stagflation. Stagflation means declining output with rising inflation. And until that time in our history, we really didn't think that was possible, that we could have declining output with rising inflation. But that certainly is what happened then. And a lot of those same factors are at play right now. Increasing oil prices due to a global event outside of our borders, rising wages, rising inflation. That's exactly what we're seeing go on right now with decreasing output. So it's going to be interesting to watch. It's time to be very defensive, certainly, as you start planning any kind of home purchase or potential home refinance. If I can be of any service to you, don't hesitate to reach out, mark.milam@highlandmtg.com.